You're here because you want to cut through the noise. Yeah. Get a real understanding of what's shaping our world. We get it.
Mm-hmm.
Today, we're plunging into something really crucial, the future of interest rates here in the UK.
And what's fascinating, the kind of unexpected role that immigration is playing in that whole picture.
Exactly.
We've really dug through the expert forecasts, the economic commentary, the latest migration research, all to bring you the key takeaways.
Right.
Our goal today is really to make sense of why those super low interest rates we saw, before 2021, why they're likely gone for good.
And how the flow of people in and out of the UK is a surprisingly big piece of this puzzle.
It really is.
Think about it. How much it costs to borrow, what happens with prices, the housing market, even, well, who's available for jobs. It's all connected.
Definitely.
We're going to try and unpack those connections, hopefully give you a few of those, now I get it moments.
Let's do it.
So let's start with the basics. Where are we right now with UK interest rates and where are the experts thinking they'll go?
Okay, so as of, March 2025, the Bank of England's main interest rate, the bank rate, it's sitting at 4.5%.
4.5%.
Yep. And what's interesting is the Monetary Policy Committee, they just voted 8-1 to keep it there.
Wow, 8-1. That's a strong majority.
It is. It suggests a pretty cautious approach from the bank, doesn't it?
Cautious definitely feels like the word. The bank's governor has talked about no preset path.
Right.
Rates aren't just on autopilot.
Exactly.
Sounds like any cuts we might see are going to be very carefully considered. Really depend on the economic data.
That's the message. Data dependent. So are the big brains predicting a quick return to those near zero rates we had not that long ago?
Yeah, is that on the cards?
Almost universally, no. The expectation is more like a gradual decline. A slow glide downwards is how some put it.
A slow glide.
Yeah, but certainly not a drop back below, say, 2%.
Okay.
For example, the OBR, that's the Office for Budget Responsibility, the independent forecaster, they see the bank rate only falling to around 3.8% by mid-next year.
3.8%.
Yeah.
Still quite away from zero.
Right. And a recent Reuters poll of economists, pretty similar. They expect rates around 3.75% by the end of this year.
Uh-huh.
Financial markets are pricing in something similar too, maybe around 3.5%.
Okay, so the consensus seems pretty clear. We're staying significantly above that 2% level for a while.
That's the strong feeling.
What's driving that? Why this expectation for, persistently higher rates?
It's a few connected things, really. NIESR, the National Institute of Economic and Social Research, they forecast rates settling around 4.0%.
4%.
Yeah. And their argument is that this is actually close to what economists call the neutral rate for the UK economy right now.
Neutral rate. Like the economy's cruising speed. Doesn't speed it up or slow it down?
Exactly that. And what's interesting is that this neutral rate, this cruising speed, is probably higher now than it was before the pandemic.
Why is that?
Well, things like global trade becoming more fragmented, higher levels of government debt, factors like that are contributing to this kind of new normal.
Okay, so it's not just about fighting the inflation we see right now. There are deeper, sort of longer-term shifts happening.
Precisely. Global and domestic shifts that mean rates are likely to stay higher than we got used to.
Right.
As one commentator put it, we're seeing higher inflation expectations become a bit embedded.
Right. People expecting prices to keep rising.
And the tight labor market is creating these second-round effects. Basically, businesses find it hard to get staff, so they pay more.
And then those higher wage costs feed into prices.
Exactly. That persistent wage pressure limits how much the Bank of England can really cut rates aggressively.
So they're constrained.
To some extent, yes. Some analysts are even saying we might only see one more rate cut this entire year in 2025.
Just one more. Wow.
So, yeah, the key takeaway here is expect interest rates to stay several percentage points above 2% for the foreseeable future.
Higher for longer. That seems to be the message.
Right.
Okay, right. So let's bring in this other really interesting piece. Immigration. How does the movement of people actually affect this whole picture, starting with inflation, that thing we're all focused on?
Yeah, this is where it gets, complicated but fascinating, because immigration seems to have this dual impact on inflation. It pushes in opposite directions.
Okay, how so?
Well, on one hand, when more people come to the UK, It generally increases the supply of labor, right?
More workers available.
So, with more people looking for work, the pressure on wages to rise really fast tends to ease off a bit.
Okay, that makes sense.
And there's research from the Bank of England supporting this. It suggests immigration has had a, quote, small negative effect on average UK wages.
Small negative. Okay.
And an IMF study looking at the US, but probably relevant here too, found big increases in immigration could actually reduce inflation by maybe zero point 0.3, zero point 0.4 percentage points long term.
So more people coming to work could actually help keep prices down by sort of cooling wage growth.
That's the main idea, yes. And we've seen hints of this in the UK. Goldman Sachs analysts pointed out that after Brexit, when the flow of EU workers reduced,
Yeah.
that likely contributed to a tighter job market, which then fueled more persistent inflation.
Ah, okay. So the flip side is higher immigration could help moderate inflation.
That's the logic. They noted core inflation, the underlying rate, stayed stubbornly high, partly because the UK labor force hadn't grown as fast as elsewhere.
Hang on, there's another side to it, isn't there?
Mm.
More people means more demand for stuff,
Absolutely. That's the other side of the coin.
especially things like housing.
That
That must push prices up.
Definitely. Higher immigration naturally increases overall consumer demand. More people need goods, services. That puts upward pressure on prices.
And housing is the big one.
It's particularly noticeable there. The Migration Advisory Committee, they advised the government estimated that a 1% population increase from migration tends to raise house prices by about 1%.
1% for 1%. Wow.
So yeah, while immigrants contribute labor, including potentially building homes, in the short term, that increased demand can definitely push up housing costs.
So it's this balancing act. Immigration might lower inflation via the workforce, but raise it via demand, especially housing.
Exactly.
What's the general view? Which effect wins out overall?
Generally, the thinking is the net effect on overall inflation is modestly negative or perhaps neutral.
Modestly negative or neutral?
Okay. But, and this is important, the type of migration really matters.
How so?
Well, since Brexit, the mix has shifted, right? Fewer lower-wage EU workers, more non-EU migrants, often in higher-skilled roles.
Right.
And that's created complexities. Some sectors, like hospitality, social care, they still face big labor shortages despite high overall migration. So there's a worry among some analysts that if you tighten the rules too much, like raising salary thresholds for visas,
Yeah.
you could actually make those labor shortages worse and potentially slow down the fall in inflation.
Oh, interesting. Kind of counterintuitive.
It can be. So given the recent high population growth, mostly non-EU, the current thinking is that this higher net migration is probably helping to dampen underlying inflation pressures.
Which might give the Bank of England a bit more breathing room for gradual rate cuts later.
Potentially, yes. More room for gradual easing down the line.
Okay, let's zoom in on that housing demand point. We all feel how expensive housing is in the UK. How much is immigration driving that?
Well, population growth is a major driver of housing demand, no doubt about it, and immigration is a big part of that population growth.
Right.
Research from the Migration Observatory at Oxford Uni highlights that basically we haven't been building enough houses relative to population growth for a long time.
We know that story well.
So each additional person migrating here tends to add to the competition for existing housing, pushes up costs.
And that 1% population rise leading to a 1% house price rise figure we mentioned.
Yeah, that comes from government and OBR modeling. While local effects can vary, the overall national trend seems pretty clear. Sustained high immigration adds significantly to housing demand.
And we were talking about record high levels of migration currently, aren't we?
We are. Net long-term migration hit around 728,000 in mid-2024, a record number.
728,000. That's huge.
It is. And that level of population increase definitely puts extra pressure on housing affordability.
So what needs to happen with house building?
Well, the OBR projects that, just to keep pace, the number of new homes built each year needs to rise significantly, maybe to around 300,000 by 2030.
300,000 a year.
Yeah. They reckon about 1.3 million extra homes are needed between 2025 and 2030, and a big chunk of that need is directly linked to household growth from migration.
So higher migration means more people needing homes, limited supply means higher rents and prices. How does that feed back into overall inflation?
Housing costs are a big slice of the inflation calculation, the CPI, and a huge part of everyone's budget, obviously. Higher rents, higher house prices, they directly push up that inflation measure. And remember, new migrants often rely heavily on renting, at least initially.
Right, so rental prices feel it strongly.
They do. So while we said immigration can be disinflationary through the labor supply,
It's definitely inflationary through housing demand.
undeniably. But as we said, many analysts think the downward pull on wage inflation slightly outweighs the upward push from housing costs for overall inflation.
Right.
The crucial point, though, is the policy angle. If you drastically cut migration, yes, housing demand might cool, but you risk shrinking the labor force, worsening skills gaps.
Which could keep overall inflation higher for longer.
Exactly. It's that trade-off again.
Right. Okay, let's shift focus slightly to just the labor supply itself. How critical is immigration for the UK workforce right now?
Absolutely critical. It's been a vital source of growth, especially recently.
Why, especially?
Because participation rates among UK-born people are already quite high. Plus, we have an aging population, lower birth rates.
So fewer young people entering the workforce naturally.
Right, so immigration has become really key in just expanding the number of people available to work.
And do migrants tend to work at higher rates?
The data generally shows that yes, people born outside the UK tend to have higher rates of employment and participation than UK-born individuals.
Interesting.
And this was really clear in 2022 and 2023. Huge boost to the workforce directly because of net migration.
Those numbers were quite something, weren't they?
They were. The OBR estimated that the net migration of over 600,000 in 2022 alone will add about 350,000 to the population over 5 years, and roughly 300,000 of those will be working-age adults.
Wow.
And the OECD, the group of developed countries, their analysis showed that the super high migration in 2023 added over 1 percentage point to UK labor force growth.
1% just for migration.
Yep. Compare that to about 0.5% pre-pandemic. It's a big jump. And this influx has definitely helped fill vacancies across loads of sectors.
Healthcare, hospitality.
Exactly. Health, social care, agriculture, services.
But despite all these extra workers coming in, we haven't seen unemployment shoot up for UK-born workers, have we?
That's a really key point. Most research suggests the impact on pay and employment for UK-born workers is, well, pretty small overall.
And small, how?
Minimal impact on overall employment levels, maybe some slight distributional effects, perhaps slightly slower wage growth in some lower-skilled jobs, maybe small benefits in higher-skilled ones, but overall, not dramatic.
And the Bank of England's research agrees.
Yes. Their work also found only a modest negative impact on average wages. Basically, the UK labor market has absorbed these flows pretty well. Unemployment stayed low, around 4%, and productivity hasn't shifted much either way because of it.
So immigration isn't just adding numbers, it's also kind of counteracting the aging population problem.
Exactly. That's a huge part of the story. Like many developed countries, the UK population is aging, lower birth rates, more people retiring.
Right.
Without immigration, our working-age population would actually start shrinking. The OBR even forecasts the overall employment rate would dip by 2029 without migration.
Because more people would be leaving the workforce than joining.
Precisely. So immigration is basically stopping the dependency ratio, the ratio of non-workers to workers, from rising much faster.
How much migration is needed just to keep things stable?
Well, independent projections suggest long-term net migration needs to be around 300,000 to 350,000 a year just to keep the working-age share of the population steady.
Just to stand still, effectively.
Pretty much. So the crucial point is immigration helps offset this demographic decline. That's vital for maintaining economic output, tax revenues.
Supporting public services.
Exactly. The OBR even estimates higher migration generally reduces public deficits over the long run because migrants are mainly working age and pay taxes.
That's a really significant point, often missed. Okay, so looking ahead then, what do we know about future migration trends, and how might government policies change things?
Well, the big shift was Brexit, obviously. Ending free movement from the EU, moving to a points-based system.
Right.
We've actually seen EU net migration turn slightly negative recently.
Really? Fewer EU citizens coming than leaving?
On a net basis, yes, in 2024. And at the same time, the rules for non-EU migration have been tightened up quite a bit.
The 2024 migration package.
Exactly. Raising salary thresholds, skill requirements, stricter limits on dependents migrants can bring.
And the government hopes this will reduce numbers significantly.
Their own estimate is that these measures could cut net migration by up to 300,000 a year.
But are the independent forecasters buying that?
Not entirely. The OBR, for instance, has actually revised its migration assumptions upwards recently.
Upwards, despite the new rules.
Yes. They're now projecting average net migration around 350,000 a year for the next few years,
Yeah.
up from their earlier guess of 290,000. They're factoring in the policies, but still see flows remaining quite high.
So still a lot of uncertainty, but the consensus is maybe a fall from current records, but perhaps not as sharp a fall as the government targets.
That seems to be the general view, yes. Projections are always tricky here, but that's the direction of travel most expect.
Okay, so bring this back to the Bank of England and interest rates.
Yeah.
How do these potential migration numbers affect their decisions?
This is where it all connects, right? If you have high levels of net migration,
Yeah.
that supports economic output, helps fill jobs, potentially without causing wages to overheat and fuel inflation too much.
Yeah, so it makes the bank's job slightly easier, give them more room.
Essentially, yes, it provides a bit more flexibility. Conversely, if policies really did clamp down hard on migration,
It could make the labor market less flexible.
could do. And that might complicate the bank's fight against inflation. Some analysts worry that very strict limits could actually force the bank to cut interest rates less aggressively than they otherwise might.
Because a tighter labor market means more wage pressure, keeping inflation sticky.
Precisely. And remember the context. Even with headline inflation falling, those inflation expectations are still quite high. Wage growth is still significant. All this suggests the bank will likely stay pretty cautious. As one expert said, with global shocks and domestic wage pressures, they'll need to be gradual and careful about lowering rates.
Gradual and careful.
So the bottom line really is, expect the bank rate to stay several points above zero well into the mid-2020s. A return to those, 0.1% rates we saw pre-pandemic, that seems effectively off the table now based on forecasts.
Okay, so let's try and pull this all together from our deep dives today. The big picture seems to be UK interest rates are set to stay significantly higher than those lows we saw back in 2021.
That's the main message, yes.
And it's down to a mix of things: persistent inflation expectations, the dynamics in the labor market.
Absolutely.
And what's been really eye-opening is understanding how immigration plays this really quite significant and complicated role in it all.
Exactly. It's multifaceted. Immigration can help lower inflation by boosting the labor supply, easing wage pressures, but it can also push inflation up by increasing demand, especially for housing.
And the current thinking is the net effect is probably slightly downward on inflation.
That seems to be the consensus view right now, yes, modestly downward.
And critically, the policy choices the government makes about migration levels, they could really impact the Bank of England's ability to manage inflation and therefore where interest rates end up.
That's the crucial link we've explored. It's all interconnected.
Which leads to a final thought, maybe, for you listening. Given how these powerful forces, rates, inflation, migration, all interact, how might unexpected global events, or maybe shifts in domestic policy, further change this long-term outlook for rates and immigration here in the UK?
It's a really dynamic picture, isn't it? Constantly evolving. Understanding these connections is going to be so important for navigating what's ahead.